In today's video, we're going to talk about 6 powerful ways that you can use your taxable account in retirement to both save on taxes and get the most out of your assets. Now, before getting into all the ways a taxable account can help you in retirement, it's worth noting why a taxable account sometimes gets a bad rep. Having some diversification in a taxable account when entering retirement can really give you some additional options, as we'll discuss in the 6 strategies we're going to talk about in today's video. But you generally don't want to oversave in a taxable account. Generally speaking, your taxable account will grow at a slower rate after taxes than your IRA or Roth accounts will, because taxable accounts can really be a leaky bucket. When you have interest, dividends, or you sell a security in an IRA or Roth, everything is essentially self-contained within those qualified accounts, and there's no taxable event. When you have interest, dividends, or sell a security in your taxable account, this is an action that will cause you to owe taxes. If you pay taxes during growth, you will have a tax drag on your portfolio and thus reduce your after-tax returns. So it's generally wise to have some diversification in a taxable account, but we don't want to overdo it. But now let's talk about the ways a taxable account can greatly help you in retirement. Reason number 1, planning for health insurance prior to age 65. We're talking about Affordable Care Act insurance here. When you look to the public marketplace for healthcare insurance in retirement, the amount you will pay will be tied directly to something called your reported income. Report a low enough income, and the government will essentially subsidize your insurance, and you could essentially pay next to nothing for great insurance. Report a very high income, and a married couple could be paying north of $2,000 plus per month. So healthcare can be either a massive expense in early retirement or essentially a non-factor. But we will see a tug of war on the income side. How can you take a sizable income and enjoy the early years of retirement, but then report a low income? We have to use this reported income equation to our advantage. Most income will count against you dollar for dollar. I have examples on the screen. Some income, like Roth withdrawals, won't count at all to that reported income. The problem is you might want to not exhaust that Roth account so early in retirement. Well, a taxable account here can help because it will only partially count against you. Say you have a $100,000 position within that account with $75,000 of cost basis, meaning $25,000 of capital gains. You can sell that full position, take $100,000 of income to live on, but only have $25,000 count against you for reported income. It's just that only the capital gains are reported against you. So a taxable account used in this way early in retirement can translate to thousands saved per month. Reason number 2 is one of the biggest: free liquidity. Qualified accounts like IRAs and Roths are fantastic. They give you a tax advantage of saving taxes either on the contribution or on the growth and withdrawal respectively. But then there's this looming issue with these qualified accounts. The government essentially puts golden handcuffs on you and your money, forcing you sometimes to continue to work. You must reach age 59 and a half before your IRA and Roth accounts become completely liquid. Now, this is fine for most, as most plan on retiring after 59 and a half. But for those that have done well financially and have the ability to retire earlier, this rule can completely torpedo their retirement. Now, there are some ways to access these qualified accounts prior to 59 and a half, but they typically come with a cost or complexity in some form or fashion. On an annual basis, I typically come across a handful of early retirees that are constrained from retiring because of this 59 and a half year rule. They are wealthy by any standard, but they are not liquid wealthy. You need to be liquid wealthy to be able to retire successfully. One of the best parts about a taxable account is that you have no liquidity constraints. You can invest in this account type and withdraw those funds at any given time at any age. This is basically the IRS's trade-off. If you want maximum tax advantages, you're going to have those golden handcuffs. If you want free liquidity, you might pay slightly more in form of taxes. So if you're someone who has any ability or goal to retire before your 60s, I highly recommend building some savings in a taxable account. And the first reason we discussed further ties into this. Strategy number 3, paying Roth conversion taxes from your taxable account. Now, there are a lot of good reasons to use your taxable account to pay Roth conversion taxes. I won't cover all of them in this video, but I will cover one specific topic. Even if you have to sell a security, incur capital gains, and then pay Roth conversion taxes, most of the time it still makes sense to pay your Roth conversion taxes from that taxable account. And here's one of the biggest reasons why. You get more out of that Roth conversion. Let me explain. It's important to understand how your income stacks in the eyes of the IRS. Capital gains will always stack on top of ordinary income. For instance, let's take a single person that has $100,000 worth of ordinary income and $10,000 of capital gains. Now that ordinary income will stack on first and fill the standard deduction, 10% bracket, 12% bracket, and 22% bracket. Then capital gains stack on after and are taxed at the 15% bracket. Why does this matter for paying Roth conversion taxes? Well, let's say that you Roth converted $75,000 in the 22% bracket and you paid taxes right out of that conversion. Well, the taxes paid will reduce the amount we are able to convert and ultimately get into that Roth IRA. So we only get a little more than $58,000 from the actual conversion when we're paying taxes out of that conversion. However, if you pay taxes out of your taxable account, you're able to get that full $75,000 conversion. And here's why. Because of the capital gain brackets, whether you convert $58,500 or you convert that full $75,000, you are going to be in the same 15% long-term capital gains bracket. So you can fill up that full 22% bracket with the full $75,000 conversion and then sell whatever you need to in that taxable account and pay the exact same rate. So you end up getting more out of that conversion out of the same target of maximizing that 22% bracket. Strategy number 4. So as I went through the logic of how capital gains stack on top of ordinary income, if we think deeply about this, we realize that ordinary income is really that variable that makes a taxable account less efficient. For instance, if we had a married couple and they had mostly Roth assets and a sizable taxable account, they would find that their capital gains bill over time will be incredibly small, maybe even non-existent. Here's why. There is a ton of room in the 0% long-term capital gains bracket, specifically for a couple. For instance, a couple in 2024 can show up to $94,050 of taxable income and still be in that 0% long-term capital gains bracket. And nothing sounds sweeter than paying 0% in taxes. But this $94,050 is after the standard deduction. So let's break this down a little bit further. Say that we have a couple over 65. Well, the standard deduction is currently $29,200. And if you're over 65, you get an over 65 add-on deduction. Adding this all together, this means that you can show up to $126,000 of income before you ever see your capital gains taxed at all. So as you think about your overall tax strategy, it's worth considering how each of these accounts intersect in order to keep your tax bill as low as legally possible. Strategy number 5, inheritance planning. One of the biggest advantages in the US tax code is something called step up in basis. When you pass on other accounts, like an IRA to the next generation, that next generation doesn't get out of taxes. You effectively pass on your tax liability to them. A taxable account or capital asset is different. When you pass away, your tax bill is effectively wiped out. Let's use an example. Say that you have a $1 million taxable account that has $600,000 of embedded gains. Now, if you sell out of those gains and pay 15%, your tax bill would be $90,000, and obviously that taxable account would shrink in value. But the moment you pass away and pass that account on to, let's say, a son or a daughter, that $90,000 tax bill disappears because your heirs receive a step up in basis. They could withdraw this entire account the next day and owe nothing in taxes. Now, this is a powerful estate planning strategy that should be maximized if you have the goal of giving to the next generation. But don't let the tax tail always wag the dog. There are times when a tax hit today can be a better long-term choice. Let's say that you have a big stock position in your taxable account, and that stock has a rough outlook or future ahead. You might have a ton of gains in that stock position, but are you better off holding that position while it loses money or underperforms? Or are you better off taking a tax hit and upgrading that performance? With a long enough time horizon, the performance play is often the better play. I have an example here comparing a balanced fund to an all-stock fund. Let's say that you have a balanced fund because earlier in retirement, you didn't know if you were going to need to use that taxable account. So you wanted some safety in case you needed to withdraw at any given point in time. Now that you are further into retirement, you realize you are in a great spot and are primarily planning for legacy. If you are planning for legacy, we care a lot less about safety and a lot more about growth, most likely. But say this is your taxable account situation. 60% of that account is currently unrealized gains. Well, over the next 10 years, if we just use historical 60-40 growth rates, we'd expect that $500,000 to grow to $1.13 million. Let's say instead we had to pay a higher capital gains rate at 18.8%. The example I have on the screen shows that the higher expected performance in stocks versus a balanced portfolio will overcome that tax hit over time, especially when we extend this beyond the 10 years I'm showing. At the end of this 10 years, the more aggressive portfolio edges out the other in after-tax value and also step up in basis value. So just keep in mind, step up in basis does not mean that no changes should ever be made until you pass away. We need to be managing all of the relevant variables here, both performance costs or upside, as well as the tax cost or upside. Then finally, we have a less common strategy called net unrealized appreciation or NUA. This is a strategy that involves both your 401k and your taxable account. Let's say that you've been working for a company and have been purchasing company stock regularly within your 401k. At the time of leaving that company, you have the option to do something called an NUA. An NUA is a strategy where you're able to transfer that company stock from your 401k to a taxable account, and what will happen is you will pay ordinary income taxes on the cost basis, but then your gain now becomes a normal unrealized gain. This strategy is only powerful for those with big gains within their company stock position. And so let's consider why this might be advantageous. You might be a classic retiree that has way too much saved in their tax-deferred accounts, and because of this, required minimum distributions are estimated to be a really big issue down the road. If this is the case, the best way out of RMDs is through Roth conversions. Well, you pay ordinary income taxes when either Roth converting or when withdrawing from that IRA or 401k. But moving it to a taxable account, you might be able to exit a big portion of that 401k with a much more minor tax cost. For instance, in this example, that company stock represented a $400,000 position. Now, if we were able to convert that $400,000 over time and pay 22% as a tax rate, they're basically paying $88,000 in total taxes. If instead they use the NUA, they would pay that 22% tax on the cost basis, but then when they withdrew the gains, they'd pay a lower, more preferred long-term capital gain rate. Now, by just using these general variables, right off the bat, they'd be able to lower their tax bill by nearly 30%. But not only that, there are big improvements down the road as we think about the RMD implications that keeping more in the 401k would have. So for those that qualify, using a taxable account to get company stock out of your 401k can be a really powerful strategy and can help minimize those RMDs in one big swoop. Now, I hope as I went through these 6 strategies, it helped generate some ideas on the best way you can use your taxable account to your advantage in your retirement. As we talk about taxable accounts, however, mismanaging these accounts can cause them to be a leaky bucket. Investing in these accounts properly is just as important as utilizing these accounts properly. Now, here are 2 videos that will help you invest more tax efficiently. Click on each of these videos to learn more. Always remember, you don't need more money, you need a better plan. Thanks so much for watching, and we hope to see you in the next video.